Welcome to Do You Ever Wonder? The show that brings you answers to many of the questions that you may have, but with no one to ask. Do You Ever Wonder is hosted by Mike Haltman, CEO of Hallmark Abstract Service, who, like you, has always been deeply curious about a wide variety of topics. Each week, Mike will be speaking with guests who are leaders in their field and who have inspirational stories to tell. So now, sit back and enjoy the show.
Hi, everyone. This is Mike Haltman. I am the CEO of Hallmark Abstract Service and the host of Do You Ever Wonder? And today we are very happy that we have a fantastic guest who's in the real estate space, but in a very unique sector of the real estate space. And it's a sector people have heard the term, but they don't necessarily know what the term means, what it entails, and basically what it can do for somebody, or it can actually, if you don't do it right, it can hurt somebody. So I would like to say hello to Rob Pecha, also known as 1031 Rob, also known as the QB of 1031 exchanges. Is it?
Your 1031 exchange quarterback, or that's what I officially have trademarked.
Okay, that's great. So welcome.
Thank you for having me, Michael. Greatly appreciate it.
100%. So, again, it's a 1031 exchange is a very niche part of the commercial real estate market. But before we get to that subject, tell me a little bit about your background. I know that you were not always planning on becoming a 1031 exchange specialist.
Certainly not. Yeah, far from it, Michael. I have an interesting background. I actually do have a military background. I was an Air Force Academy cadet half a life ago with aspirations to become a military aviator and drop bombs on the enemy. That didn't happen for medical reasons. So I pivoted, took a different route, and today I'm saving the world in a different way. I'd like to think it's a little more safer, but I'm helping investors navigate these things called 1031 like-kind exchanges. So that was me half a life ago. The good news is I've ported very good things from that, like an honor code, like the discipline, and I've ported that into my practice today. I'm very quality centric, not only with people that I recommend, but also products, and we can get more into that later.
So, how did you morph from wanting to be a fighter pilot and dropping bombs to becoming a 1031 exchange specialist? There's a lot of areas that you could have gone into. How
Sure.
did you end up here?
Absolutely. I mean, I could have stayed in the military. That was an option. I could have become an officer many different ways, but I was laser focused on being an aviator. When that was taken from me because of medical reasons, midstream, I decided that it was God trying to tell me to go a different route. I had no idea that 1031 was waiting for me. In fact, I didn't even know what that was at the time. I just felt like the rug was ripped out from underneath me, but I was open. I was open to opportunities that the world would bring me. And I said, you know what? I'm a pretty smart guy. I'll figure it out. And I ended up getting my degree in international business only because I speak a bunch of languages. And as I said, Michael, I was open to the world. So I was open to opportunities. I didn't find this immediately. I spent a little bit of time in the energy sector after my schooling. And in 2008, I joined financial services. Great year to start financial services, right? And I started in many of the disciplines that financial advisors do because I'm a financial advisor by license. I have a Series 7 and a 66. I'm with an alternative broker out of Chicago. But basically, I started different disciplines. As a financial advisor, I did life insurance, disability, long-term care, annuities, pension max, portfolio management, you name it, I tried it. And finally, in 2012, I came across this specialty. I said, you know what, this is unique, this is different, this is underserved. There aren't many of us that do this to begin with, even fewer that are like me. So I'm laser focused on this. I leave a lot of money on the table by not touching the other stuff, not engaging in the other areas of practice that I am licensed to do. But I find people today want a specialist, not a general practitioner. Me personally, I work better in one discipline. So I like the uniqueness of the space. I like the fact that today I'm a 1031 consultant, and I basically do all the handholding inside of a 1031, making sure that people know what they're getting into. What is it? Why would you want to do it? What are the timelines? What are the rules? That sort of thing. So I do that all day, every day. And then I step in with this modular basket of these pre-approved products called DSTs. That's really my sweet spot. And that solves a couple 1031 problems.
DSTs. Why don't we start at the beginning? So there'll be people who see this who don't have any idea what a 1031 exchange is, let alone a DST.
Sure.
So why don't you just describe why is it that somebody what is a 1031 exchange?
Sure. So let's start there. Let's start at the 30,000 foot level. 1031 exchange, what is it? Well, it's a tax code that was created over 100 years ago. The IRS said if you sell an investment property, and that investment property could be a brownstone that you rent out, it could be a warehouse, you can roll those proceeds into something else held for investment purposes, in other words, like kind, and it qualifies for the 1031 exchange. Why would you want to do that? Well, typically there's a large capital gains tax attached to it. A lot of these people have bought these investment properties like 25, 30 years ago, so they have a lot of capital appreciation on it, probably depreciation recapture as well. So if they correctly execute a 1031, they can save themselves that tax, effectively keeping more money in their pocket instead of losing a big chunk in tax to Uncle Sam. But it's not the easiest thing to navigate. It's got these pitfalls that can kind of jam you up.
So they're not avoiding the tax, they're postponing the tax.
They're deferring the tax. Technically, it's tax deferral, but in the 1031 exchange game, they say kick the can till you kick the can. It sounds a little corny, but everybody gets it. The idea is you want to keep rolling. So whether you use my products, the DSTs, or you do traditional 1031s where you roll into other investment properties, if you keep rolling, you'll keep deferring the capital gains tax. Now, the investor in his or her lifetime can never actually kill the tax for themselves. But when the investor passes away, the heirs actually get the stepped up cost basis. So there is a way to eliminate the tax, but not in the investor's lifetime.
So there are some rules to a 1031 exchange, rules that if you violate, you basically create a taxable event, and a lot of it has to do with timing. So explain a little bit about the timing. I'm planning on selling my building. What do I need to do in order to shelter that money, whether in a conventional 1031 or in a DST? What are my guidelines? What are my timeframes that I have to really abide by?
Sure. So that's a good point, Michael. These timelines and rules are very hard and set. And 1031s are easy to mess up or derail. And if you mess them up, you owe the tax. So it's like, why even go down that route? So you want to set yourself up for success. What I do infuses certainty into the transaction. Getting back to what you said, let's just say hypothetically you sell an investment property today. Let's call it a brownstone in Brooklyn. You sell that investment property. From today, you have 45 days to identify what you intend to roll the proceeds into.
And when you say identify, I have to announce that I found X property at X address and or however it's done, but I have to identify what it is I'm rolling my money into.
Correct. It's like a formal indication of interest that needs to be in writing and sent to what's called a qualified intermediary or QI. So that's, again, a 1031 exchange rule. You have to use what's called a qualified intermediary to custody the funds and await instruction for deployment. You can't actually sell that investment property and have the money sit in your bank and then choose to do a 1031. That would be disallowed.
So now the 45 days is the first step in order to identify the property. Then you have to choose an intermediary. Now that's a whole nother kettle of fish, because an intermediary is basically warehousing your money. Is basically a fiduciary, or is fiduciarily responsible for your money. And I've heard horror stories where people put their money with a fiduciary and the money goes poof, and they're out this investment money that they spent a lifetime accumulating. And tell me about how you vet an intermediary.
Yeah, for sure. That's super important. And just to take two steps back, you mentioned, first step, the 45-day, and then the qualified intermediary. It's actually the other way around. You'd want to make sure you'd hire a qualified intermediary prior to that sale, meaning they need to take custody of the funds and stick them in escrow. Then your 45-day clock starts. So we can talk about that more later. Getting back to the QI recommendation in the space, the QI space is actually not regulated. I could literally go out to the street right now, take a table out there, put a tablecloth on it, scribble QI on it, and I'm in business. There is no regulation around it. So as you said, you want to be very careful. Are you choosing an entity that's bonded? Is this their core competency? Do they do this a lot? Do they have a good track record? These are all things that are important when you consider a qualified intermediary, because as you alluded to, they're not all created equal and your money could disappear. You want to deal with somebody who's reputable. And of course, the way I run my practice, I deal with qualified intermediaries that have very high accolades behind them, that have been doing this for a long time and have excellent track records. So you want to be careful who you choose. Products are important. You want high quality products, but you also want high quality people in your corner as well.
Well, that's 100% in anything you do, but particularly, and I would imagine, and I don't know because I'm not a CPA, but if you put your money with a qualified intermediary who then loses your money, steals your money, you now have a taxable event, I would assume.
Yeah, I mean, there are all kinds of horror stories, as you alluded to. Your money could just flat out disappear along with the QI. So
You
that's
still
why,
owe you still owe the taxes.
well, it could be a whole can of worms. I mean,
Yeah.
it's endless, really, how much pain it can cause. But that just goes back to the point of, if you're going to go down this route, if you're going to do a 1031, you want to have, I always say, the right advisory board in place, meaning everybody in your advisory board plays a very specific role. You have your broker trying to get you top dollar for the sale. You have your real estate attorney advising you on the legal. You have your CPA advising you on the tax, qualified intermediary holding the funds in escrow, maybe me standing by at the ready. Everybody plays a very specific role. So you want to make sure everybody's not.
You left out a key cog in that process, which is the title insurance company.
Well, absolutely. Anytime property is bought, sold, or mortgaged, there's a need for title. So you would necessarily step in.
Well, I want to just throw in a quick anecdote. So we recently we work with a lot of buyer's attorneys, and we have a buyer's attorney now who has a client who put their down payment in the seller's attorney's escrow account. That seller's attorney disappeared with their money. And what we always tell people is that the vetting people, really vetting people, not just taking other people's words for things necessarily, but really doing your own research. It's, we we take so much on ourselves for stupid things, but when it comes to the real things, then we just cede control to other people, which is not necessarily wrong if you truly trust them and have and they've been vetted, but still.
True. 2 points to that. One, it always amazes me the lack of preparation that tends to go into these things. Oftentimes, it's a large amount of money at play, and investors a lot of times have no no idea which direction they want to take. It's kind of like shooting from the hip and like, I'll figure it out. And 45 days, it's a lot of time. I'll figure it out. That's not really the case. You really want to get ahead of this. I mean, me, I'm ex-military. I do that as much as I can. You want to get ahead of this as much as you can. And getting back to your point, who do you vet and how do you trust them and how long does that take? That's a process. I mean, I've been in this space for over 10 years now, Michael. So I've kind of seen it all, and everything in between. You do want to make sure that you're dealing with reputable people. Obviously, if you're taking a recommendation, consider the source. But again, the way I run my practice and the reason I went off on my own and I created a 1031 Rob brand for myself, I'm very quality centric. So I do that across the board.
So not to dwell on the QI, but I find it fascinating. Do you have any QI horror stories that you've run into in your time where people have put their life savings and have come out with nothing?
Unfortunately, yes. I wish I could say no, but
Obviously, they didn't use you.
no. I've never, unfortunately, I've never recommended one that fits that profile. But I have heard horror stories of people losing their money. There are plenty of cases of qualified intermediaries out there that will do what's called backdating, which is, you have this 45-day window. Some people try to get cute and you're already past the 45 days and they kind of just amend it in their ledger and say, okay, we'll put this property in here, stick it in. That's actually a felony. So if you're dealing with these types of people, buyer beware.
100%. So if I'm doing a conventional 1031 exchange, can I identify and buy more than one building?
Absolutely. So depending on what your circumstances are, a lot of people, when they sell an investment property, they use what's called the rule of three. There are actually three identification rules: the rule of three, the rule of 200, and the rule of 95%. The rule of three is the most common. It says if you sell that, let's call it brownstone, you can identify three properties irrespective of value. And in most cases that fits. They're selling one property they've owned a long time. They kind of have their eye on something else, oftentimes similar in grade, right? Like they sell a multifamily, they're looking at multifamily, and usually they have their eye on one or two things. So the rule of three fits. However, there is the 200% rule. It says you can name any amount of properties as long as you don't blow past 200% of the overall aggregate value. So if people are looking at multiple things, certainly that comes into play with DSTs, because DSTs could be one location or it could be a bunch of locations. You just want to make sure you're using the right rule so you don't violate the identification rules.
So, in another lifetime, I was a bond analyst and a bond trader, and we used to have tax loss swaps. And tax loss swaps are where would sell one bond for a loss and buy a like-kind bond as a replacement. The bond actually had to be somewhat like-kind. But in 1031 exchanges, if I'm selling a multifamily, I can buy vacant land, I can buy a warehouse. Like-kind is a very broad term in 1031s, right?
Absolutely. And like kind really just refers to, is it held for investment purposes? And there's a broad spectrum of things that are considered like kind. People frequently think if they sell a brownstone, they need to pick up a brownstone, sell a warehouse, you need to pick up a warehouse. It doesn't work like that at all. It's exactly like you said, you can cross different asset classes. The litmus test is really, are you selling something that you held for investment purposes, meaning, did you rent it out or something? And are you acquiring something held for investment purposes? You can't do this with primary residence or vacation homes.
Right. So now the conventional 1031 exchange is property into property. There's a saying that I read and that's where we get into DSTs, that some owners of properties, whether they're older and don't want to deal with it or just don't want to deal with it, want to avoid the three T's of managing a building. And those three T's are tenants, toilets, and trash.
That's right.
I find that fantastic. But it is true that, when you're the landlord of a building, you deal with things. You're managing things. You have a tenant who says my toilet's backed up. You have a tenant who says whatever they say. But now that's a little bit of a segue into a DST. So that's a Delaware Depository Trust, correct?
Delaware Statutory Trust.
Delaware Statutory Trust. And I guess that makes sense. Otherwise, that would have been a DDT. And
The lesser known DDT.
Right. So explain a little bit about what a DST is.
Sure. So a DST, or Delaware Statutory Trust, by the way, was created in 2004 when the IRS had a revenue ruling and they said, guess what? If you package up real estate as a DST, it's considered like kind. So right up there with everything else that you can chase within your 45 days to satisfy that identification of replacement properties is this basket of DSTs, essentially. Doesn't matter what asset class it is, doesn't matter where it is, DSTs are considered like kind. So the good news for investors is I always have a ready to go menu of these DSTs ready to go. I have no closing risk. They come in all shapes and sizes. You can choose different asset classes: retail, multifamily, student housing, self-storage. They're all over the country, but they're 100% passive to investors. So getting to your point, they solve a couple 1031 problems, namely this one that you're going down right now, which is investors that have been landlords for a long time. And as I said, they frequently have bought these properties 25, 30, 35 years ago, whether they had a good run as landlords or not. They're just kind of at a point in their lives where they don't want to deal with that anymore. They don't want to get those panic phone calls and, the toilets are leaking on Christmas Eve. Like, they just don't want to deal with that anymore. They want the tax advantage of a 1031. Obviously they don't want to pay the capital gains if they can structure it properly under a well-executed 1031. But the idea of picking up another replacement property, they knew what their headaches were for the last few decades. The idea of making the lateral move into somebody else's is not attractive. That's where DSTs can be really helpful, because you get institutional grade properties. Again, you can choose different kinds, but at the end of the day, they all act the same way. Everybody's collecting their share of the rent roll sitting in this DST. There are no managerial responsibilities. So investors are free to check out, go on vacation, go play golf, travel, whatever. And you really don't need to worry about it. You still feel like you're invested in real estate in these different sectors, but you don't have any of the headaches typically associated with it. You collect a check every month. You wait for this ride to end, which is approximately 5.5 years down the line. Could be a little shorter, could be a little longer, but basically you're just putting it on autopilot, waiting for this thing to full cycle through. And for investors that don't want to be landlords anymore, it could really be a home run, because it frees them of those responsibilities they've known for a long time.
But going back to the beginning, where you had mentioned that you have a variety of different DSTs, a variety of different property types with a variety of different ending dates. How do you vet each individual DST? Are there certain managers that you have dealt with in the past that you like? How do you rate them? I remember how bonds were rated, and actually they weren't rated all that well. But how are DSTs rated?
So it's a great question, Michael. And similar to the qualified intermediary dilemma, right? Like, there are so many options out there. How do you drill down to what makes the most sense? With the DSTs, it's not a whole lot different. I have access to a menu probably about this long of various different sponsors. I think the last time I checked the most current report, there's 39 active DST sponsors in the space. Do I like all of them? Absolutely not. And how do I make that determination? Again, how long have they been doing this? Have they weathered tough storms? You know, what happened last year and the year before during the pandemic? What happened in 2008? How did they react when things got difficult, and what was the impact on their investors? Those are all super important things in line with, their underwriting. Is it conservative? Are they aggressive? Because as you can imagine, they're not all created equal. You have newer sponsors out there. They try to grab market share by dangling a bigger carrot. I get it. I completely get it. But they don't have the track record, and they haven't been in the space as long as some of these proven sponsors. That's why me personally, you'll hear me refer to them as top tier sponsor. It's my own language. I kind of just coined it myself. But these are essentially sponsors that are ultra conservative, and they've been doing this for a very long time and have very satisfied clients behind them.
So DSTs there's some pros to a DST. Obviously, the first one we spoke of was you don't have to deal with the headaches necessarily, just the headaches if the sponsor has an issue. But what are some of the pros to going into a DST over, other than that, doing it yourself?
Sure. So there are many, many pros to going into a DST. You can get arguably better diversification, not only by asset class, but also geographically. The minimums for DSTs as compared to some of the like triple net options that investors frequently look at are much, much lower. Triple nets, you're often talking about multiple millions to get into. DST minimums are typically 100,000. So arguably you can get better diversification, not only by asset class, but also geographically across the country. It's also a great estate planning tool. A lot of people use this so they don't have to burden their loved ones with managerial responsibilities down the line. They either don't have the ability to do it, or they don't trust them, or they just don't welcome it. It's a great estate planning tool. It's a great way to basically divest yourself of properties that are underperforming. You may have, multifamily properties or rentals that are basically, a wash. You're not really making much on it. This is a great way, as I said, to get institutional grade properties that are professionally run by these professional property management companies. And really, you pass all responsibility over to them. If you deal with the good ones, they know what they're doing and it's going to run the course. If you deal with the newer guys, good luck, maybe not. But those are some of the benefits of of putting your money into a DST versus some of the more traditional options. We spoke about the first category, which is people that don't want to be landlords. DSTs solve a couple other problems. Let's talk about that 45-day identification window for a second. You have 45 days to identify where you want to send the proceeds. People think that's a lot of time. And I see 1031s derail all the time because, they procrastinate. They think 45 days is enough time. They'll find it. They'll figure it out, whatever. And then they blow past day 45 and they've run out of time and effectively derail their exchange. People also fall in love with one thing. I see that a lot too. And if you're past day 45 and something happens and it's real estate, it could, you've effectively blown up your exchange. DSTs make great backup identification properties, and they also don't obligate you to purchase those properties. So I tell investors, if you're looking at something more traditional, or things look good, or things look so, consider the DST as a backup, because all you have to do is identify it within that window, and it could serve you very well. I've had investors that swore to me up and down, they don't need it, they got it handled, they're looking at two things, but weird things happened, and they were happy to have the DST because at the end of the day, it didn't derail their exchange. So though it may not be their first choice, sometimes it saves the day. It's also good for picking up residuals. So people that are doing sometimes larger exchanges may have equity left over after they've deployed money into their primary and or secondary choices. So let's just say it's a $10 million exchange. They find a perfect opportunity that gobbles up like, 9.5. There's still, in my example, $500,000 left. Frequently people think they don't have any option there. They're like, okay, I'll just pay the tax on what's left. I'm happy, I got my primary choices. There's a better way to do it. You can complement their real estate portfolio by putting that maybe into something like a self-storage or a medical office space to complement their real estate portfolio, earn a decent rate of return for the ride, and then have the opportunity for back-end depreciation of that money down the line. It's just a better use of the money. So when I say 1031 solutions to 1031 problems, these are some of the things that DSTs do well, in addition to the other things I mentioned. What are they not so good at? Do you want me to balance it out?
Oh, I was going to get into the cons.
Yeah, so some of the cons are, first of all, these are fractional ownership interests. Again, in 2004, the IRS said, if you package it up as a DST, it's considered like kind. But these are one of two ways that you can fractionally own real estate inside of a 1031. The other is something called a tenant in common that was created in 2002. These are DSTs created in 2004. So the fractional ownership interest, what does that mean? Investors don't actually own the underlying assets. They're sitting in a pool of investors. Everybody's just collecting their share of the rent roll. So for investors that need to own the assets outright, it may not be such a good fit. I wouldn't say it's really a con, but it's something that the investors need to be aware of. It's all about the profile of the investor. The other thing is these are not particularly liquid investments. It's generally about a 5.5 year hold. Again, it could be a little shorter, it could be a little longer, but you're generally looking at about 5.5 years where this money is going to be tied up. So for people that are thinking about pulling this money out early, you start to lose a lot of the value that the DST offers if you have designs on pulling out of it early. The way to get maximum benefit out of the DST, get into it, satisfy your exchange, collect that mailbox money for the ride, as I call it. And then on the back end, the expectation is that your investment comes back with friends, and then you have the same options again. You can pay the tax, you could do a traditional 1031, or you can do DSTs again. So the option is
What about the load? Like a mutual fund load. What's the cost to play?
sure. So the load typically inside of these DSTs is anywhere from 10 to 12% all in, but that's an all in number, meaning everybody gets paid to do what they're supposed to do. Commissions to people like me, legal fees, property management fees, acquisition fees, disposition fees, it's all factored in there. The good news is when I quote a DST to an investor and I tell them, hey, I have a great multifamily program here, it's paying 3.4%. That's a net number to the client, meaning they factored in all those expenses, all the ongoing and upfront expenses. That's a net number. So it's not like they invest $1 million and it gets wound down immediately. That number I'm quoting is net. So they never see any additional fees on top of that. The good news is, Michael, that's non-invasive. So their full amount goes to work. But to be clear, and I always make it clear, the investor pays that over time. Meaning if I say that the cash on cash number is 3.4, it's probably higher, but they factored all these things in. The investor only sees a net number. So for the most part, they accept that.
Here's one other con that I see that you can probably dispel, but you're giving up any potential for appreciation of the underlying asset.
Not true.
Okay, good. I knew you could dispel
Not true. The end game for any of these, Michael, whether you're dealing with the top tier sponsors that I love or some of the newer guys, whatever the assets are, whether it's retail, multifamily, student housing, whatever, they want to sell these assets to like a pension fund or an institution down the line for a profit. That's the end game. Every single DST is the same that way. So they want to make money on this, and investors participate on that back end appreciation. So that's the goal. They really don't want to sell at a loss. And that's one of the things that could drag it out from like a 5 year projection to maybe a 6 or a 7. If market conditions are not quite right, they're just going to sit and they're going to wait for the right offer to come along. Conversely, I like to make investors aware it could happen sooner. I manage expectations 3 ways. The compliance answer is 7 to 10. So you want to manage expectations further out. The reality is it's closer to 5, 5.5, and it could be sooner. We've seen as short as 2.5 years and 3 years. It's all predicated when they can get a good sales price. And that's when investors experience what's called a liquidity event. And that's when they have options, pay the tax, do another 1031, get your people lined up, get your qualified intermediary, or you could roll into DSTs again.
So what if the asset depreciates and the people running it and the DST, and there's actually a loss? Is that loss also spread among the fractional owners?
In that case, yeah, in that case it would, but I've not experienced that in the sponsors that I deal with.
Okay, no,
Yeah. Though there are no guarantees here, people frequently ask me, like, Rob, what are the guarantees? I say, look, first of all, these are subject to the same risks that you already know. So these are packaged up as securities, number one. They come with private placement memorandums about that thick, and it tells you on page 1, principal subject to risk. Now, the good news is investors are already used to these risks. Inability to collect rent, changes in tax law, tenant vacancies. These are all things that can affect these properties negatively. But if you deal with a good sponsor that has great stewardship of the underlying properties, hopefully you're not going to run into these problems. And as I said, in my experience, I've been in this space over 10 years. I've not had that problem.
Well, the one thing I can tell from our conversation is that the 1031 exchange is a complicated process. It's a process that you need to have trusted advisors on, like in many things. And obviously, and I've known you for a little while, you fit that bill. You are a trusted advisor. You take your role extremely seriously, which is a pleasure to see, because how often do we come across people who don't take their roles as seriously as they should? So if somebody wanted to reach you, how do they do that?
So with a moniker like 1031 Rob, it's very easy. It kind of started as a joke, but it took on a life of its own. And when I realized the stickiness that it has, meaning people know what it is or people don't know what it is, they associate me with those four numbers. And it's led to some beautiful things and a tremendous practice that I've been running. If you just Google 1031 Rob, I come right up. My website is 1031rob.com. My email is info@1031rob.com.
Well, that's great. I think we spoke about it when we had lunch about a month ago that I'm going to change my name. I'm going to copyright Title Insurance Mike and see how that flies.
You might have to drop the insurance part, just title Mike, flows better.
All right, sounds good. But listen, you're obviously an expert in your field. It was great having you on. We're going to have to do this again because I don't know that we did more than just skim the surface, but you know what? You were great to have on, and I appreciate you coming on.
And I appreciate the spotlight, Michael. And to piggyback on what you said, the 1031, we spoke about it before. It's very much a symphony, and you need this advisory board to be tight because everybody has to play their role. I pull up a chair and infuse certainty because as you're sort of starting to get a feel for now, these DSTs solve a couple problems. Maybe a client uses me all in. They're just done being a landlord and they're like, Rob, you're the expert. This is all you do. Cool. Tell me where to send it. Maybe they use me for a little bit of scrap left over that they don't want to pay tax on. 50-50. Some people go into triple net and then do some DSTs or nothing at all. I have plenty of clients that I've just been a free education, but just keeping my services in their back pocket has given them more confidence and more options inside that transaction. Never a bad thing. And that's why I call myself your 1031 exchange quarterback. It's not because I'm a huge football fan, it's because I do all the hand holding.
Oh, listen, if you're selling a $10 million property, the last thing you want is for your 45 days to tick down with no options. So whether somebody does a conventional or does a DST, it is good to have you in their back pocket. So again, thank you very much, and I look forward to speaking again.
Thank you, Michael. Greatly appreciate it as well.
Thank you for listening to Do You Ever Wonder? And we hope that you enjoyed the show. Next week, we will have another terrific guest telling their story. And if there are any specific topics you'd like to hear more about, please don't hesitate to let us know. Our curiosity, like yours, knows no bounds. Please subscribe and like and share this episode on your social media. See you next week.